What is up, everybody? Crypto Noah back with another video covering another concentrated liquidity manager to show you all the possibilities that exist in order to generate passive income on your idle crypto assets and stable coins so you can accumulate as much as you can ahead of the next bull market so you can sell them for high prices. Before we get into this video, I do have to say this should not be taken as financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only, and like we always say, do your own research, but use this channel as a starting point. So today, we're actually going to be covering my favorite concentrated liquidity manager in Gamma. We're going to go through the docs like we have been on the past videos. We're going to go through their strategies. We're going to go through their tokenomics. We're going to go through their audits. I'm going to do a platform walkthrough, show you the different yields. And at the end, I'm going to tell you if I would use Gamma or not and why. So without further ado, let's get into the content. All right, so here we are on the docs, and we're on the introduction page here on Gamma, and they give like a brief history of liquidity. They talk about for most of the history of crypto, it was traded through a centralized broker or directly peer-to-peer. DEXs or decentralized exchange emerged in the late 2010s, but were inefficient, centralized, and had poor liquidity. However, Uniswap changed that in 2018. They were the first truly automated market maker, and they kind of show how Uniswap worked. They show pretty much their dominance and how most of the liquidity was on Uniswap v2. And they kind of just break down what concentrated liquidity is. If you've been on the channel, you know what it is, but just for the people who are new watching this, concentrated liquidity allows you to provide liquidity on a decentralized exchange. And instead of it using, like let's say you want to provide liquidity in ETH and USDC, instead of just saying, hey, use my liquidity for whatever the price of ETH is, that can be from $900 to $10,000, concentrated liquidity allows you to say, hey, only use my liquidity from 2,000 to 5,000 or 2,000 to 2,100. It gives you full flexibility as to your ranges, but the tighter your ranges, the higher your yield, but also the higher your impermanent loss. So there's always a trade-off, so you really got to know what you're doing when you're providing concentrated liquidity. They go on to talk about the challenge, and they talk about how concentrated liquidity pools introduced a new risk called impermanent loss. And impermanent loss is basically, if you're in ETH USDC, and let's say the price of ETH is $2,000, and you provide liquidity from the range of 1,000 and 3,000. As it moves up, you're going to be buying the losing asset. And in this case, that's going to be USDC. So if you go above that $3,000 range, you're going to be in all USDC. Depending on how you set up your strategy, this could be a good thing for you because you can use it to take profits. Same thing on the downside. When ETH is dropping, and let's say you go below 1,000, well, now you're in 100% ETH. And that can also be your friend because if you want to buy ETH for cheap, that can be a good way to do it. So it talks about all the issues and how they solve it, etc., etc. They claim to provide LPs with the most optimized performance on a variety of platforms and blockchains, and they're really trying to move the needle on concentrated liquidity managers. So let's kind of dive into strategies. So it says fees and impermanent loss are the respective forms of yield and risk for concentrated liquidity. Liquidity providers and Gamma generally seek to maximize fee production and minimize impermanent loss through strategies. Strategies are rules or guidelines that guide the management of Gamma's vault. Gamma's strategies are heavily automated using automatic triggers to conduct management practices like compounding, rebalancing, and setting ranges. And it goes to talk about fees. Fees are driven by volume, or in other words, more trading happening. More volume equals more fees, but in concentrated liquidity, fees are also driven by concentration and range. A liquidity provider who concentrates their liquidity near the trading price will receive significantly more fees than someone who sets their ranges wide. And we kind of just talked about that. They go to talk about some of their incentives. So incentive programs, they have their own section, but they basically use incentives to increase the yield. So like let's say you're in a wrapped ETH optimism pool, and optimism gave Gamma some OP tokens to give out as rewards to bootstrap liquidity for the token. Well, now you're not just making money in ETH and OP from trading fees, but you're getting optimism rewards just from being in the pool. And that is one of my favorite things about this platform. Then they go on to talk about gas fees. So it says gas costs to maintain vault/pool also count against a liquidity provider's yield, but the fees are only statistically relevant on certain blockchains. For example, ETH, which says with some it can cost $20 to rebalance, on some it can cost 10 cents. So you really want to, keep that in mind if you were to use something like this, or if you're providing liquidity in general. Like when you're on ETH, it might be a good idea to maybe think of a long-term strategy, or be able to read the block explorer and know how to understand GUI and things like that, so you can rebalance when gas fees are low. So here they go on to talk about types of strategies. So it says Gamma has a number of different strategies for users of the protocol. Some focus on asset classes as well as advanced hedging strategies. So the first one is dynamic range, which is wide or narrow. It's the most common strategy. It shows like their ranges here. So in this diagram, it looks like this is the price. This is the actual range that they have set up, and this is what price has to hit in order to be rebalanced. So it says, this line, once price crosses this line, it gets rebalanced. But this is like the range. So, one thing to keep in mind with these is that, like I said, impermanent loss can be your friend, and rebalancing can actually hurt you. So you really want to make sure you know what you're doing. It says here, liquidity ranges are automatically rebalanced when certain rebalance triggers are hit. Liquidity ranges can be set for a pair, and rebalances are automatically triggered by the price moving a certain percentage one way or another. Then it says accrued fees will be compounded back into the position regularly on behalf of LPs, compounding yield. Auto rebalancing allows for a passive LP experience. Then it goes on to say, the wide range strategy caters to long-term liquidity providers and their risk preferences. It takes into account high volatility and rewards in the selection of ranges. And this is an important one here. Wide ranges generally have less impermanent loss in a high volatility environment. And over the long run, the savings and impermanent loss will likely outweigh the higher fees in a narrower range. So they're basically validating my belief about yield farming, in the sense that, I hear people a lot of times say, hey, I want to do this to make money and just kind of live off the interest. If you have millions of dollars, that is more of a reality. But if you're LPing with a few thousand, that might not be the best thing, because this is not a get rich overnight thing. Yield farming, in my opinion, works best when you have a long-term strategy. And they said it right there. And they said even when you have a tight range, the impermanent loss that you'll suffer probably won't outweigh if you just had a wider range for a longer period of time. Or we even show you how to set up tranches. And if you're interested in this kind of thing, we have a whole yield farming course that shows you how to find pools, how to set your ranges, how to track them, how to know when to get out, conducting proper technical analysis so you can master your entries and your exits. So if you're interested in that, click the link in the description, book a free strategy session with one of our team members. We're going to ask you questions, see where you're at on your investing journey, ultimately see if our platform is a good fit for you. If it's not, we'll be able to point you in the right direction and at least teach you a thing or two. They were also talking about how, like, when a trigger gets met, they automatically rebalance, and they take the rewards and they also compound those in. Normally when I yield farm, I don't like to compound my rewards because, like, I don't know what's going to happen in the future. So my rewards can get lost in impermanent loss. So I normally like to take my rewards, send them to another wallet where I can maybe just hold them and wait for my price targets to be met so I can sell for a higher price, or maybe employ some kind of single side staking strategy so I don't have to worry about impermanent loss because I earned it from yield anyway. So if you're in a volatile stable pair, or even a volatile pair, and they're constantly rebalancing, what if price is just going up and down? That rebalance is locking in that impermanent loss for you. And more importantly, Gamma makes fees on your volume. I didn't see anything that outlined the fees they charge in a clear manner, but I'm pretty sure they make fees on your yield. So while they say they keep impermanent loss in mind, whether you experience impermanent loss or not, you're still going to get a yield, and they're taking their money off top. So they're making money no matter what. And that's the biggest thing that I always like to tell people about these platforms. Even though I like Gamma, if you can do this thing on your own through learning on a program, kind of like how we teach, you'll make more money. You don't have to worry about fees. You'll be able to rebalance on your own, and you can even set up your own rebalancing triggers and not have them get rebalanced every time things are going up and down, because long term, I haven't found that that's the best way to yield farm, and I've been yield farming since 2020. So let's get back into these docs and keep going through this. Then they go to talk about a narrow range, and it says a narrow range strategy caters to short-term LPs and their risk preferences. The narrower the ranges, the more you'll earn in fees and rewards, but likely incur more losses in a high volatility environment. So we talked about that. This is like a strategy for like stable coins. You can make the range really, really tight because price normally doesn't go, too far from $1. They show a pegged price, and these are used with pegged assets like staked tokens. So like, liquid staked ETH derivatives and things like that. And it says liquidity is provided directly around the net asset value of the provided asset. So example vault for that is like Rocket Pool ETH and Wrapped ETH. One's ETH, one is a derivative of ETH, so they're going to be around the same price. So these are good pools to get in because it's almost like single side staking, but not really, because things can happen with the liquid stake token that can make it go above or below peg, but it usually returns back to the mean. And they have a few things in development here: delta hedging, gamma hedging, momentum hedging, pairs trading, etc., etc. Then they go on to talk about incentives. We kind of touched on this already. They talk about the supported platform. So these are the active blockchains where you can use Gamma on. All of these are the ones in development. Hopefully they get Radix on here one of these days. These are the active decentralized exchanges. So as you can see, they have a lot. And then these are the decentralized exchanges they have in development. And these are their partners. They got a lot of them. Next is the Gamma token. Now, full transparency, I do not own the Gamma token. I don't plan on buying the Gamma token. I don't have anything against the project. I actually like it, but I just feel like there are more tokens I would rather hold, to be honest. So it reads here, the Gamma token is a financial instrument that allows the owner to earn fees from Gamma vaults by staking their Gamma instead of directly providing liquidity to a vault. Rather than providing liquidity directly into Gamma vaults and accruing fees from the selected pools, Gamma stakers earn a percentage of the fees accrued in all Gamma managed vaults. I'd be interested to see like the APY in that. We'll check that out when we go through the platform walkthrough. But when you stake Gamma, you get X Gamma, which is the staking token, and they give all the details on that. If you're interested in the tokenomics, you can look at all of that stuff here. They give you the max supply. I think all of the tokens are unlocked by now. They give you all the vesting schedules and things like that. Yeah, it looks like the last one was unlocked in July 2023. At least that's what that's saying here. Then they have an LP Academy. One thing about Gamma, this is the best documentation on providing liquidity out of any of the concentrated liquidity managers that I've covered so far or even seen. So they talk about why you should provide liquidity. They talk about liquidity in TVL. Basically, I've talked about this on a channel as well. The best pools have high volume to TVL ratios, which means, let's say you have a pool with a TVL of 10 million, then you have a pool with a TVL of 50 million. If you have one 10 million, one 50 million, but the volume in the $10 million pool is $20 million, so it's double the volume, but the volume in the $50 million pool is only 25 million, well, you're going to make more money in the smaller pool because the volume to TVL ratio is better, meaning that the volume is double the TVL. But in the higher TVL pool, the $50 million pool, if the volume is only half the TVL, you may still make good money, but it's more people splitting a smaller pie versus less people splitting a bigger pie. So they go to talk about all that stuff. They tell you how they're concentrating liquidity around price, all the details, volume and fees. They outline impermanent loss. They outline volume. Volume is basically the speed at which assets are trading hands. They give you guides on how to pretty much do everything, provide liquidity, how to stake Gamma, how to purchase it. If you're into that, feel free to read. They tell you how to deposit liquidity. The only thing you have to know is that, like, if you want to get into an ETH USDC pool, you can't just get into it with a single side asset. You have to have ETH and USDC. And the amount that you have to have is just like Uniswap. It depends on where the price is inside of the range that they set up. So if the price of ETH is $2,000 and they have a range of 3,000 to 1,000 and it's at 2,000, like I said, you will provide that ETH and USDC 50-50 because it's directly in the middle. But if the price of ETH is higher, you're going to have to provide more ETH, less USDC. If the price is lower, you're going to have to provide more liquidity in USDC and less ETH. So they show you how to deposit, they show you how to withdraw, they show you how to stake your LP tokens, which is cool. So when you enter into one of the pools, you get an LP token, you get a yield on that, and then you can take that LP token and stake it and earn an additional yield. And they go through all those details here as well. And like we always say, security is the most important thing in crypto. So you want to make sure if you're locking your funds somewhere or trusting a smart contract to have access to tokens in your wallet, you want to make sure there's an audit so that you don't lose any money. And as a precaution, we always tell our members, keep your main holdings in a separate wallet that doesn't interact with anything. You want to have your hot wallet connected to a hardware wallet, right? It makes it more secure. And then also the wallet that you're farming with, interacting with different smart contracts with, keep that separate from your wallet where your large holdings are, where your main bags are. So I've already went through these audits. I'll let you guys go through them. But the main thing that's important is that you want to see things that were brought to their attention that needs to be fixed, and you want to see that fixed in the next audit. And like I said, they have 3 here, so that shows that they're pretty serious about the project because all these costs. Another good thing they have is a bug bounty, so they're paying people to try to find errors in their code, which is really, really good. Okay, so now that we covered all of the docs, all of the strategies, let's do a platform walkthrough, and at the end, as promised, I'm going to tell you if I'll use this platform or not and why. All right, so here we are on gamma.xyz. You can read their Medium, Twitter, Discord. They have a pretty active following. You know, they pretty much, we pretty much covered all this stuff in the docs. These are some of their investors. Pretty good. So let's enter app. All right, so here we are inside of the app. So you can browse by exchanges. Let's start with Uniswap and see. And you can look by the actual blockchain. Let's start with OP. And I want to filter by APR because, you know, I want to make sure it's worth the fees here. So you have a narrow range here from USDC and SNX. Another thing we teach is how to, like I said, conduct proper technical analysis so that you can open up an SNX chart and see if it makes sense to even get in a narrow range pool. Just because the yield is high, like if this price moons and you're in a tight range, you just missed out on a lot of profit. So we always teach, if you want to get into a narrow pool, you put the least amount of money there. You can set up a little bit of a wider pool, put a little more there, and then set up a wide range, and that's where most of your money is. So that way, if prices consolidate within a small range, you can, you know, make a lot of passive income from the fees. But if the price moons, you still give it room to run while it's still accumulating fees, but at least you're able to benefit from the price appreciation as if you were holding. So if you click it, you get to see the data here. They show how much they rebalance. It shows the benefits here. It shows the trade-offs. And now let's see analytics here. Okay, now this is what I like about this platform. You can actually track how the pool has been doing here. So they give you how you would have did if you would have just held the asset without providing liquidity versus providing liquidity. So if you held 100% SNX, you would have made more until you got down to here. So the gamma versus hold is down 5.5%, and the gamma position is down 4.8%. Holding the initial deposit, you'd have been up 0.69. Holding 100% USDC, 0. And holding 100% SNX, 0.825. So whenever you want to enter a strategy, you want to back test it and see how it would have performed under certain market conditions. The best thing is if you can predict where you think the market's going and try to back test to see how that pool performed against a similar market condition, if you'd have been better off holding or LPing, it can be something that you can look at and then say, hey, let me set up this range on my own, because if you set up the range on your own, I'm not sure if they're accounting for fees here, but if they're not, this is actually even lower. So you can actually copy what they're doing here, copy the ranges because you can see them. You can deploy it on your own. You can use something like Aperture to rebalance. That's if you're using UniV3. And you can do the same strategy and make more money because you don't have to worry about Gamma making fees. And you can control when you rebalance, because rebalancing often isn't, it's good for short term. It seems cool, you're making these fees. But remember, you're locking in that impermanent loss. So you want to make sure that it's worth it or not. Let's look at this wrapped ETH OP pool. Now, I was actually in this pool for a while because they were giving away some OP rewards. And the amount that I was making in OP rewards outperformed what I could have made if I would have just provided liquidity in a range that was favorable to me and my strategy, just vanilla on Uniswap without using Gamma, which is pretty cool. And it actually performed pretty well. I actually made money from it. Let's see if we can look at the analytics, see how far back we can go. Oh yeah, I forgot you have 180 days you can look at. Yeah, so I got out about like right here. And as you can see, if I held 100% optimism, I would have been better off in the gamma position. You see the gamma position is the white line right on top. I got out before this range. I remember getting out and looking at this being like, wow, that was actually pretty good. And I was in it for a while, like for a few months, I think since like September or October. And I got out with profit, and that's because they were doing those OP rewards. You know, it shows you the data here. You can look on a certain time frame. So yeah, they give you all the data. They give you the net percentage return over time. They give you the wide versus narrow. So now you know how to look at that. Let's just look at some of these pools here. So you got wrapped ETH OP, wrapped stake ETH, wrapped ETH, 42% here. SUSD and DAI. I'm not sure what SUSD is, but a lot of people don't trust it because it's only 7.9K in here. Let's look on Arbitrum, and we want to sort by APR. Okay, it looks like, so whenever they have these diamond things by it, I think these are the incentivized pools, so you get 167% in ARB, 5% in swap fees. So they got some pretty good pools here. GNS wrapped ETH 129, ARB USDT 120, USDC Link 102. These are all narrow ranges though. You got to keep that in mind. Like you can literally copy that narrow range or make it wider and use it as a profit taking strategy. ARB USDC narrow. See, this is a good one. It says it's wide, but it's still getting you 51.5%. So that's not bad. Let's look on a different DEX. Let's look on QuickSwap. This is their highest TVL, so they should have some good pools here. We'll look at Polygon, and we're going to sort by APR. So I'm not sure what Sling is. I'm not sure what Ninjas is. I'm not sure what these are. Pragmatic USDT. That's pretty good. Let's see what these incentives are. 18% in Cash D Quick. Not sure what that is. Sounds nasty though. Wrap ETH Ave 74% wide range. That's not bad. Yeah, so they got some pretty good yields on here. So yeah, you guys can feel free to go through all the exchanges, all the dexes on all the chains. Everyone has their dex or their dex and their chain that they prefer to LP on. So let's look at Stake Gamma. 25% APY in staking. So I know this is supposed to come from all of the pools. If I was holding the Gamma token, I would definitely be staking. You know, I just am more bullish on other projects, so I would rather hold those tokens and yield farm those and get a higher yield. And the last thing I like to look at is how it stacks against other competitors in this industry. So you can see that in terms of TVL, Gamma is number 2 behind Arrakis Finance, which I just did a video on yesterday, actually. You guys feel free to check that one out. So they have 112 million in TVL, and their next competitor below them is 59 million. So they're definitely... So now that we went through everything, all the yields, all the docs, the audits, would I use this platform or not? I mean, I guess I kind of answered the question because I told you guys I would use it, or I used it. So my answer is it depends. I'm more likely to use Gamma than any other platform, at least concentrated liquidity managers. They have high TVL, and they show how their pools performed historically, all the way back to 180 days, which is good. You can backtest a lot in 180 days. So the reasons when I would use it is when I backtest something and I feel like it can outperform better than I myself can. And the only times I found that is, like, the only pool I've been in on Gamma was the wrapped ETH OP. I'm accumulating OP into the 4844 upgrade happens, then I plan on selling it because I think it'll pump. That's for another conversation. But I was able to outperform just chilling in their vault versus doing it my own because the OP rewards were so fat. So if there's ever a reward token that I really want to accumulate that I can't outperform in a pool of my own, I would definitely use it for that. I trust them, they're battle tested, all that stuff. The reason why I wouldn't use it is the same reason why I wouldn't use other ones. They're fees. They make money no matter what. And I like to consider myself a professional yield farmer. I like to, do them on. I think it's fun. And I think it's a skill that everyone should learn in addition to trading, because mixing them together, you get some really good results. So with that, I'd like to conclude this video. I hope you got value from it. If it's something I didn't cover, let me know in the comments. If it's something I said wrong or missed, let me know in the comments. Let me know what protocol you guys want me to cover next. Consider subscribing if you really want to support the channel. And with that, I will end this video. I love all of you who are watching, and I'll see you tomorrow for the next one. Take care.